Hey credit warriors, welcome to the show, and in this video I want to talk about the elephant in the room. Why I am no longer using credit. Now there are a variety of factors that have contributed to this, and in this video I'm going to break down the reasons behind this and show you what I'm doing instead. And this video is brought to you by Kudos, but more on that later. Alright, so I go by the name The Credit Shifu. Credit is kind of my thing. I use credit cards to accumulate points and miles for luxury travel. I use loans and credit lines to create cash flowing businesses. And I've leveraged my almost 800 credit score to get the best interest rates on the mortgage on my primary residence, construction loans, and car loans for any car I buy. But times have changed, and now in 2023, I'm no longer taking out any new debt. In fact, I am doing the exact opposite. I am looking to pay down debt and maximize cash flow so I can build up a war chest of funds ready for the next recession, the next crash in property prices, or the next period of low interest rates, or all three. So why do I need to take this course of action? Well, let's give you the background. So in response to the sky-high inflation that we've seen over the past 2 years, which peaked at 9% in 2022, Jerome Powell and the Federal Reserve have raised interest rates. Actually, that clip was wrong. The money printing is what they did back in 2020 and 2021. Now they're trying to contract the money supply. We should really play that clip in reverse. So the Fed funds rate now sits at 5.12% after Powell started regular rate hikes back in 2022. Raising interest rates encourages people to invest their money in government bonds and bank savings accounts since they can now get a kind of decent cash flow from those products. Bank savings accounts are paying about 5% or just under, and the 6-month treasury, which is a short-term government bond, is yielding about 5.5%. This means they pump less money into stocks and also spend less money consuming products. In addition, the average mortgage rate now for a 30-year fixed mortgage is around 7%. Average car loan rates are above 7% too, an increase of an average of around 4% just 2 years ago. So basically now, people are buying less cars because interest rates on car loans are too high. And this has caused chaos because we now have oversupply with all the vehicles they produced over the past couple of years when demand was high because interest rates were low and the economy was flooded with COVID stimulus money. I mean, people were even buying Lamborghinis with that money. That guy was a Florida man. But now times have changed and Florida man can go back to dealing with his alligators. Because interest rates are too high to buy a new car with a loan or a new house with a mortgage, in my opinion. A 7% mortgage on a home loan amount of $300,000 will cost you $500 more per month than a 4% rate would have. So this is the reason that I am out of the credit game too. The cost of borrowing is just too damn high.
It's too damn high.
So the old thing of borrowing money to buy a car, even if you have the funds, because you could use that money to get 7 or 8 or 9% in the stock market and the car loan only costs you 4%, that doesn't work anymore. However, I am still using credit cards and paying them off every month in order to collect the points and miles to book luxury travel vacations. I actually just booked a trip to the Big Island of Hawaii, staying at the Fairmont Orchid, and then on to the Hilton Waikoloa Village Resort, both of which look awesome. And just for clarity, the recent tragic fires in Hawaii are on Maui, not on the Big Island. But apart from credit cards, in other areas, I'm going full on Dave Ramsey on you guys.
It's $1 trillion of you buying crap you can't afford to impress people you don't even really like. Maybe you should stop that.
Yeah, well, it's not exactly like that, but I am completely stopping borrowing money. And in this video, I'm going to take you through the loans I have. I'm going to show you the interest rates. I'm going to tell you whether I'm going to pay them off early. And I'm also going to show you what I'm doing with my money going forward. But first of all, since I am still using credit cards, and you should too to get the benefits as long as you can control your spending, I want to talk to you about the sponsor of today's video, Kudos. Kudos is a free browser extension that helps you earn more rewards by recommending the best card from your wallet for every purchase. Like when I recently booked a flight on JetBlue, Kudos suggested the Amex Platinum for 5 points per dollar on flights booked directly with airlines and showed me other hidden benefits like travel insurance. But that's not all. Kudos also also doubles your credit card rewards on over 15,000 sites. Yes, you heard that right. With Kudos, you can potentially double your rewards whenever you shop online. Like here on Booking.com, without Kudos, I would have earned 3 points per dollar on travel with my Chase Ink Preferred, but now I'll receive 6 points per dollar with Kudos. And did I mention that Kudos is completely free? All you have to do is just add Kudos in 2 clicks and shop like normal. Then sit back and relax because the average Kudos user saves over $750 per year. So stop leaving money on the table. Use code SHIFU to double your rewards when you sign up for Kudos with my link below, or go to joinkudos.com/shifu. All right, so I'm pretty lucky that all the installment loans I currently have open on my credit report are at rates considerably lower than the current average rates. Now, I may still want to pay off some of these early to increase cash flow, and paying off debt is a form of investing that you might not have thought of. Let's say you have a $500 a month payment on a loan for something, say a car or a personal loan, and you have 10 months worth of payments left. Well, if you had the money to do it, instead of investing that money in the stock market, it would actually make more sense to use $5,000 to pay off that loan early and free up $500 per month in extra cash flow. By contrast, if you wanted to create $500 per month in extra cash flow with a fixed income investment, you would have to invest $120,000 in something like treasury bills or a CD with a 5% interest rate. But we've just created $500 per month extra cash flow with just $5,000 in spending. So I'm going to be looking for debts that I have that I could potentially pay off early to increase cash flow so that I can then use that cash flow and store it and create that war chest so I have money to invest in the future. And typically I'll be looking for debts with interest rates over 5% because the ones under 5%, I think it's not really worth it to pay them off. The interest is so low, we probably won't see those rates again for a while. So first up, we have a mortgage on this primary residence, and the interest rate on that is 4.5%. I took the mortgage out in 2019. I should have refinanced it at 3% in 2021. I'm kind of an idiot for not doing that, I will admit it. Will I pay this one off early? No way. I will most likely hold this one for the full 30-year term. If I was to take out this mortgage today, it would cost me 7%. In fact, some guy phoned me up, a real estate agent, and he said, "Do you want to sell your house?" And I was like, no way, man. If I was to sell this and buy somewhere else, I'd be paying 7% or more. So yeah, I'm going to probably hold this for the full 30-year term. Inflation has devalued the amount I'm spending each month on this mortgage anyway, which is another plus. The only thing I might do is refinance it in the future if we're able to get down to below a 3.5% interest rate. It normally makes sense to refinance if the interest rate you're offered is a full percentage point lower than your current rate. Then we have a $25,000 personal loan from American Express at a 5.5% interest rate. This is a loan I took out last year just because I knew that rates were going up and it would be probably my last chance to get any kind of large loan at a low interest rate, and I needed some cash because I was putting basically all the cash I had, $70,000, into my Airbnb build, and I actually needed some additional cash to do some home improvements on my own house. For example, I had a load of trees that needed to be cut down in the backyard. This ash tree was killed by emerald ash borer. It is a beetle that is sadly killing millions of ash trees in the eastern United States. I had another one where the trunk was split like that, and both trees were posing a danger to the surrounding houses and had to be cut down. I also had a few $1,000s worth of repairs to do on my Jeep Grand Cherokee. Anyway, I took that loan and I spent it all, and it proved to be a smart move because if I wanted to get the same loan today, it would cost me almost 9%. I've been paying the monthly payments of $760 with no problem, and my balance is down to $16,000 now. With an interest rate of 5.5% and the way it's structured, the short term of this loan, it's just 3 years, which means the monthly payment is $760 per month. You think of a car loan for $25,000, it would be over 5, 6, 7 years. No way you'd be paying that much per month. So anyway, that means that this loan is a prime candidate to pay off early and free up that $760 per month in cash flow, and I'm going to do just that. Once I finish building the cabin, I should have a surplus of cash because I paid a builder $70,000 to start the build on a $340,000 house, but I'm getting a construction loan of $297,000. However, I have overspent by about $10,000. Most of that was bringing soil here from another site to create this massive platform so that you can't see the road down there. But that still leaves me $17,000 that I will get back, and that is enough to pay off the loan and free up $760 per month in extra cash flow. Oh, and since we're here, we might as well talk about this thing. I have a construction loan on this property for $297,000 at a 4.6% interest rate. It's interest only for the first year, and the amount rises as you draw more funds from the loan. Right now, I have drawn $168,000 funds from the loan to get to the stage in construction that we are at now, and it's costing me about $700 per month in interest payments. This one I will never pay off early. 4.6% is a great interest rate, and since it's for a business venture anyway, the mortgage will eventually be paid each month by the revenue from the business once I start renting it out. The only thing I might do in the future would be to refinance at a lower interest rate and cash out perhaps $20,000 to use in the next deal. Then I have a car loan with $16,723 balance on this car at a 5% interest rate and a $460 monthly payment with 3 years left on the loan. Now this one is a little borderline. I could pay it down early and free up $460 per month, but the interest rate is a little lower at 5%, so taking into account the opportunity cost, I could probably make more money investing that lump sum elsewhere. And because the loan originally had a longer term, it was like 6 years I think, so I've already paid off half of it, and that's why the monthly payment is lower than the personal loan I just showed you. So I think it makes more sense just to leave this one. But oh, what's that? What about this brand new Jeep Wrangler Sahara? Well, this car is actually the first car I have ever leased instead of bought. You know, like Ty Lopez does.
Because lease. That means it's a lease. There you go.
This car sets me back just under $1,000 per month in a lease payment, but if I had bought it, the payment would be higher because of the roughly 7% interest rates or more that we currently have on car loans. But the cool thing is, the money I'm paying in the lease is actually paying down the price of the car. So at the end of the term, I will have the option to buy this $63,000 car for just under $40,000. And I'll probably have to buy it in the end anyway because I'm going to do so many mods to it. So I'll either buy it in a lump sum or take out a loan on it as long as there's a lower interest rate by then. So that's what I'm going to do with the debts that I have. But what about moves with actual money? Because, you know, I do earn money. It's not just debt. Well, I'm taking advantage of the great rates and close to zero risk that we get with 6-month treasury bills right now. I only keep about $10,000 in a savings account for emergencies, and then any surplus funds I'm putting into 6-month treasuries. In addition to that, I'm also using a smaller portion of money to cautiously buy back into some stocks. I was largely out of the stock market over the past year, but recently I have been buying back into Tesla stock. I bought in at about $180, and we're already up to the sort of $250 range. But time in the market beats timing the market. So in addition to buying dips on just a small number of stocks, I'm actually going to be using a larger portion of money just to buy into index funds in general. But I'm keeping stock market investing on the small scale since I want to build that stash of cash with really low risk by using products such as 6-month treasuries so that I'm 100% ready to pounce when the real estate market crashes, which many people think is going to be in 2024, allegedly. But maybe not. Who knows? All right, guys, that is the video. I hope you liked that explanation of why I am no longer using credit to buy things in 2023. I'm still using credit cards to buy things and pay them off every month, but I'm not taking on any new interest-bearing debt. A big thank you to Kudos for sponsoring this video. Use my code SHIFU to double your credit card rewards when you sign up with the link below. Please subscribe if you're new, hit that like button, and we'll see you next time. Bye-bye.